Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. Before we jump into our next episode, we have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.dealcatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review. We encourage your feedback. It'll help us make these episodes a better listen for you. And now, on to our next episode. Welcome back to our latest installment of the Credit Clubhouse. As always, I'm your host, Todd Anderson, Head of Content and Programming at Deal Catalyst. Joining me today is Brad Foster, Head of Fixed Income and Private Markets at Bloomberg. Brad, it's great to see you again. Thank you for coming on the show. I am really looking forward to our conversation.
Thank you, Todd, and thanks for hosting me on your show. I really do look forward to this conversation.
I think a good place to start is this convergence of public and private markets. The borrowing base now includes public and private borrowers, and lenders are now forming larger clubs with IG borrowers coming to the non-bank market to raise capital as deal sizes continue to get larger. The reality is that public borrowers are now able to raise capital through both the bank and non-bank lending market. And so I'm just curious, what are some of the motivating factors behind these new, convergence, this new trend?
Yes, that's a good question. Listen, I think in our conversations as we go out and talk to customers, the reality is the lines are becoming increasingly blurred between what is public and what is private. When we look at the way this market has evolved, it started as a single lender, single borrower, it morphed into, as you put it, larger clubs that looked a lot like syndicates. But what was really interesting is to see the shift in borrower base, whereas this was predominantly private borrowers, this was predominantly your more risky borrowers. This is now morphed very quickly into not just those borrowers accessing non-bank capital, but more and more investment grade borrowers accessing this private capital, the non-bank capital. And so when you look at where the growth is coming from, it's coming significantly from your investment grade borrower base. I think the motivating factors are the same, irrespective whether you're public or private. I think the speed, the efficiency, the certainty of execution, the flexibility that it affords borrowers. Non-bank capital can offer more flexibility to borrowers. When you look at some of the confidentiality, the way that some of these deals can get done, around not just the speed of execution, but also preserving some of that confidentiality, I think there are multiple reasons why the borrower base, whether it's in investment grade or sub-investment grade, public borrowers are shifting away from exclusively relying on public markets, bank markets, to private capital.
And so as head of fixed income and private markets at Bloomberg, what does that mean and what falls under your remit?
So my role at Bloomberg is head of fixed income and private markets. Fixed income is really across our rates, credit, and securitized products business. And so I work in that capacity very closely with our colleagues across the firm in enterprise product, in enterprise data, in CTO. And I have responsibility for making sure that what we offer our customers across the terminal and the desktop ultimately gives them what they need across all the different fixed income asset classes, from the short end to long duration, including structured products and securitized products. When it comes to private markets, my role is slightly different. Really what I'm doing and what my responsibility is I'm working across the firm to bring together everything that we offer today and plan to offer in the future that would ultimately satisfy our customer use cases as it relates to private markets. The reality is these markets are becoming increasingly interconnected between the user types, the player types, so banks, asset managers, asset owners. Those lines that we were referring to earlier in terms of the blurring between what is public and private make this a natural fit for me, where I can look at, for example, corporate credit. I can look at corporate credit not just in the context of what is the bond market, what is the bank loan market, but I can now bring that third leg of the stool together, which is obviously private direct lending. And so my responsibility across fixed income and privates really affords me the ability to not only bring that together across fixed income, but pretty much everything that we want to do as a firm when it comes to private markets.
Before we jump a little bit more into direct lending and some other topics, I wanted to talk a little bit about the language of private markets. How would you define the space today, and are we all talking the same language?
Listen, I think, at least in my own experience, when we go out and we talk to customers, or even sometimes when we have conversations internally, I do think that there is a need for a common taxonomy. I think that classifying private markets and talking the same language when we talk about not just the asset class overall, but the sub-asset classes that make up private markets, I think would be extremely helpful. When we think about private markets, we think about it in the context of not just the sub-asset classes. So, for example, private direct lending, private ABF, real assets, which could be real estate or infrastructure, natural resources. But we also think about all the different fund structures that our customers can invest in these asset classes through. And so, I think we really do think about the asset classes in the way I just described, and we think about the different fund structures that our clients, typically your LPs, your insurance companies, pension funds, sovereign wealth funds, etc., are investing in this asset class.
Now we jump a little bit more into private direct lending. Clearly banks shifted their behavior post GFC. Part of that was regulatory driven, with new regs coming, Dodd-Frank and whatnot. And then part of that was obviously becoming a bit more risk averse from some of the lessons they learned. Private credit stepped in. What makes the product delivered by private, credit direct lenders so compelling?
I think, listen, firstly, when you look at the middle market, the SME borrower base, when you think about, whether it's in the US or Europe or even recently on my trip to APAC, I think what really does stand out is there is significant growth going on around the world. And obviously what fuels that growth is the access to capital. And so I think when we look at that private direct lending space, when we look at the size of the private direct lending market today, I think it's grown obviously because banks pulled back from certain types of lending. I mean, just to be clear, Todd, banks are still active when it comes to lending. It's a core part of their business. It's what they do. But there is a part of what makes up that borrower base, the types of loans that some of these borrowers need, that just naturally is better suited to non-bank capital. And so I think when we look at the growth of this market, and we look at the growth of not just that market within the US, but Europe and increasingly in APAC, I think what is very clear is that, especially as I said earlier, as companies remain private for longer, as public companies become private, and listen, private obviously are still going public, but you're definitely seeing far fewer public companies than there were 5-10 years ago. There are a lot more private companies. That list of companies that are out there sourcing capital can differ dramatically, whether or not you're talking about sort of early stage versus late stage companies. But I think, the demand for capital, the demand for flexible capital, for the type of capital where, even for large investment grade borrowers, they can come and they can get that certainty of execution. I think it's just continuing to compound, continuing to grow. And I think the demand from companies to raise capital in the non-bank market is just continuing to increase.
What do you think they value most when it comes to, the SME corporate borrower? Is it the flexibility of the capital, more the certainty of it? I mean, they can get underwritten by banks and could be 3-4 months down the line and they get a no, or is it speed of execution?
Well, I think it depends on what part of this you're talking about. So I think when you look at if you look at the sponsor-backed universe of companies, obviously the sponsors are driving a lot of how these companies get funded. A lot of these non-bank lenders have very good relationships with sponsors. those relationships obviously exist for many reasons, one of which is access to capital. And so, when sponsors come to market with a deal, when they look to finance the companies they're investing in, they have choices, and those choices can be public or private. Those choices could be the bank loan market. Those choices could be the private direct lending market. And oftentimes, private direct lending deals are refinanced into the bank loan market and vice versa. So I think for the sponsor-backed universe of companies, it's really the sponsors working with their portfolio companies making those choices. I think when you move beyond that sponsor-backed universe of companies, I think for a lot of your sort of more risky borrowers, obviously, for banks to lend to them, sometimes the capital is incredibly punitive, and sometimes the flexibility that these companies require doesn't naturally lend itself to the type of lending that a bank would ideally do. I think when you look at your investment grade borrower base, I think, clearly the opportunity to take large amounts of debt, bank debt, or bonds, and refinance them into the private market is appealing in that, as I said earlier, it can give them the same amount of flexibility that typically that more riskier borrower base gets. It also gives them an alternative to the public markets where they can refinance some of this debt, and they know that those loans are going to end up potentially with insurance companies and pension funds who are buy and hold investors. And so I think there are multiple reasons why you've seen this growth, not just across your SME borrower base who obviously really look to this non-bank capital to fund itself, but also when you go to the opposite end of the spectrum and you look at your investment grade borrower base. I mean, some of the largest deals that have happened in the private market have been from investment grade, and as I said earlier, a large part of the growth that we're seeing around private direct lending is actually coming from your investment grade borrower base.
So if we look at the other part of the spectrum, which is LPs, they've grown to understand this product. Most allocators have said, all right, we're going to put some money to work in this market, both either through fund structures or as direct investments. I mean, do you see their views shifting, that capital shifting? What do you think about the LP component of this?
Listen, I think it's when it comes to the LPs, I mean, ultimately, as this asset class continues to expand, it gives them another place to allocate capital. I think as you see some of the larger deals coming to market, your $3-4 billion deals that are happening in the private market, I think it gives them an opportunity to put money to work in some really high quality companies at really compelling risk-adjusted returns. I think when you look at the relationships that those LPs have with GPs, I mean, a lot of these LPs have very close relationships with some of the most sophisticated private credit shops out there. They've built up a lot of confidence over time by essentially deploying capital through these GPs as an investor in those funds. And so I think for the larger investment grade deals, I think you're going to see more and more LPs coming in and making those direct investments in those loans. I think a large portion of where those LPs will continue to allocate is through various fund structures into the asset class. I think it's certainly the case here in the US. I think that's likely the case in Europe and certainly in APAC.
If we switch a little bit to more of the technology and transparency piece of this market, obviously Bloomberg is well known for their technology on the public side. Can similar technology and transparency be brought to private markets?
Yeah, I absolutely believe so. I think, firstly, I'd say that, yes, we're known for our technology, but it's not just our technology. It's data, it's technology, it's infrastructure, it's tools and workflow solutions, it's analytics. All of these different things come together across the suite of products that we offer, which could be the terminal and the desktop. It could also be our enterprise applications, whether it's our order management systems through to our risk systems. It could be through our enterprise data offering, where our customers increasingly want to consume data into their own ecosystem and use that data, whether that's to extract insights or to manage workflows, books and records, etc. So I think when you ask the question whether or not we think that the footprint we have in public and the footprint that we built up over time and the leadership position that we built up over time is somewhat applicable to private. I absolutely believe so. And I think actually I'd take it a step further and I would say this, and that is that there's an expectation from our customers that we bring that public and private workflow together, from deal screening, due diligence, origination, research, all the way through to the commit and post-commit to the end of life of these assets. Our customers want a single data, technology, and infrastructure stack that is completely interoperable between both public and private markets. They want us to bring those portfolios together for them. And so not only do I think we've built up a strong position when it comes to building the data, tech, and infrastructure that I was referring to, but I do think that there are large parts of what we've built up that we can lean on as we look to build our footprint and meet our customers where they are as they increase their allocation into private markets.
Do the lenders want this much transparency brought to private direct lending?
Listen, it's difficult to know exactly what every lender wants out there. I do think that when you look at the direct lending market, and if you assume it's around 1.8 trillion in size, there's a decent portion of that already is public. It's already out there. It's sitting in business development companies. They have their quarterly filings, 10K, 10Q filings. We already take that data today and make it available on the terminal. We want to provide that transparency. We want to provide that detail that exists publicly to our customers, and we're already doing that today. So there is already a large portion of what makes up the private direct lending market that is public. I think if you're in the school that believes that there's going to be a secondary market for private direct lending, you have to believe that certainly for more of these larger deals, the larger asset managers are going to find a way to partner with banks to essentially make markets in these loans. And so that will naturally bring more transparency to the market. But I think if you look at sort of the demand for better reporting, more transparency, better valuation, more reliable valuation, I think we've seen a few idiosyncratic cases where clearly, whether it's loans or companies, they weren't being valued, prudently. And so I think there's definitely some examples out there that are pushing the needle and pushing us towards more transparency. And certainly from our perspective, we want to be able to provide that transparency. But at the same time, I would say this, Todd, and that is that there is a portion of this market that will always remain private, especially those bilateral deals where you have a single lender, single borrower. The reality is the asset managers want to preserve those relationships. And so even there where our customers do want to keep those deals private, we want to incentivize them to bring those deals into Bloomberg. We want to be able to digitize that deal flow. We want to be able to put a data model behind that deal flow, a cash flow model. We want to be able to value those deals. But we want to also respect the fact that those deals are private, and our customers do want to preserve the confidentiality of those deals. And so you have this pool of loans that are public, they are publicly available, they're in the public domain. There's a pool of loans that our customers will want us to bring into Bloomberg so we can run the same functions and analytics on those deals for them that we can on the public deals, but we will offer them entitlement and permissioning so we preserve the confidentiality of those deals.
So the retail investor, the White House made a 401k announcement. There's been all sorts of new structures, or at least some of the structures have been around for a while, but it seems there's this new push to gain access to the retail investor. Will this help to kind of spur on a push for more transparency? Does there need to be more done by regulators? What about the retail investor component?
I think it's clear that retail has an appetite for this. I think it's clear that it's a timing issue before retail becomes a much larger part of what makes up the private market, including obviously private direct lending. I think the need for the push towards better reporting, more transparency was underway already. I think that there are many constituents across the market that would like to see that. I think the need for and the demand for consistency. I mean, when you look at, for example, some of the business development corporations out there, corporations out there, when you look at where they value some of these loans, there is because of those 10K, 10Q filings I was referring to earlier, there is inconsistency. And so I think even in the absence of retail, I think there was already, the direction of travel was already towards more transparency and better valuation. I think when you introduce retail, clearly, and that could be through any type of retail product. It could be through ETFs. I mean, we saw Apollo and SSGA launch an ETF. I don't think it'll be the last. I think you'll see more retail product created. And I do think, as we've seen in the past, the moment you see more retail participation, there will definitely be a push towards more transparency. But I would say that was probably underway already. And I do think that, especially for that portion of what makes up the private direct lending market, where you will start to see a secondary market develop, I think that was going to happen no matter what.
The streamlining of systems and architecture is clearly something that lenders will want to adopt. Why is the market still so fragmented in that area?
It's a great question. I think when we look at the tools and workflow solutions that we think our customers are going to ultimately need, and they can differ quite dramatically, Todd, depending on whether you're talking about a terminal workflow or you're talking about an enterprise workflow. I think that, when you look at the landscape of solution providers out there today, I think the best way to describe the proliferation of vendors is they offer really good point solutions. I think that what has been missing up until now is a large vendor like Bloomberg stepping in and being able to bring those tools and workflow solutions together, act as that aggregator across these different solutions to ultimately offer our customers a joined up solution. And so when we look at our ambition and we look at what we're pushing towards, we want to be able to support our customers across both public and private markets. We want to be able to bring those tools and workflow solutions together in a way that is completely interoperable between public and private. We are going to lean on our existing footprint in public markets where it makes sense. So, for example, corporate credit, we don't really think about it as public or private. We think about it as corporate credit. And we think about it as three legs of the same stool, meaning the bond market, the bank loan market, and now the private direct lending market. We already have sort of best-in-class tools and workflow solutions that exist across the public market. We certainly want to maintain and push that leadership position into the private direct lending market. When you look at the tools and workflow solutions we built up around private ABF, a lot of the sectors that are getting financed in the private ABF market are the same sectors that have been historically financed in the bank market. And so we have, when you look at those commercial endpoints we have today across the terminal and enterprise, we have those tools and workflow solutions today. And so I think those are two examples, private direct lending and private ABF, where we have existing tools and workflow solutions where it's actually, although it's a big investment for us, it's something that we can lean on. I think when you get into the real asset space, whether that's commercial real estate or you get into infrastructure or natural resources, I think that becomes a much more difficult proposition. And I think that there are definitely opportunities, even on the more sort of advanced part of it, which is your private direct lending and your private ABF, for tools and workflow enhancements from that deal sourcing, deal screening, research, due diligence, all the way to the end of life of the assets. And we obviously want to participate across that. And we want to be able to bring these solutions together for our customers so that they don't have to do the stitching themselves.
Do you think, and we touched on it a couple minutes ago about the secondary market, but do you think we get to sometime in the next few years, get to a robust secondary market with tradability, liquidity for private credit loans?
Listen, I think first off, even in the public market, liquidity is here today and gone tomorrow. So I think when you talk about liquidity and you talk about whether liquidity is there, I mean, it's typically there when you don't need it. The moment you need it and want it and you go in search of it, in my own experience, it's typically not as deep as you think it is. And oftentimes, especially when you get into your sort of your distressed and high yield markets, I think these markets are relatively thin and quite quickly move to by appointment. So when you look at the private direct lending market, I think, yes, I believe that there will be a secondary market that develops over time. I think it's more likely to happen on some of those larger deals that I was referring to earlier that are investment grade, that are typically involve many lenders. But I think that there's a large part of this market that is going to remain private. Is probably not going to get traded in the secondary. It's probably going to end up sitting in an asset manager pocket or an LP pocket, and will stay there until the end of life of that asset. So yes, I do think there will be a secondary market that develops. I do think that we shouldn't get too focused on whether or not these markets are liquid or not, because you could make the same argument about large parts of what make up the corporate credit market in public. But yes, I do think that you'll see a part of this market move to something that starts to look like a secondary market, but I don't think you can make that argument across the spectrum.
So we have a few fun questions as we look to wrap up here. Favorite sports team and/or hobby?
My favorite sports team, no doubt, the South African rugby team, the Springbok rugby team, without a doubt.
Tell us one surprising thing about yourself.
Surprising thing about, I consider myself to be super well organized, and I love symmetry.
One book that you'd recommend reading?
Long Walk to Freedom. This was Nelson Mandela's autobiography. It came out right around the time he became president of South Africa. I think it's a great read, great story around freedom and equality. It's around perseverance, sacrifice. A great read.
The most exciting part of your job?
The fact that I get to come in every day and work with some of the smartest people out there, certainly in not only within our firm, but with our customers, our clients. I get to co-innovate, co-develop. It's a really fun part of my job.
And then final question, one prediction for the next 12 months.
I would say my one prediction would be that Spain win the Soccer World Cup.
All right.
I'll make a second prediction for you for free, and that is that I think private markets are larger 12 months from now than they are today.
Well, I would agree with you on that one. I don't know about Spain. I don't watch too much soccer, but I'll agree with you on the second one. Brad, I really appreciate your time today. So thank you for coming on the show. Continued success to you and the team.
Thank you, Todd. I appreciate your time.
Thank you. Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. We have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.dealcatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review.